On the 22nd of June 2025, HM Revenue and Customs confirmed that a number of pensioners across the United Kingdom will face direct deductions of £300 from their bank accounts. This announcement has stirred widespread concern because the deduction is not optional and, in many cases, comes as a complete surprise to those affected. HMRC has explained that these deductions are connected to unpaid tax debts, errors in previous assessments, and adjustments made when incorrect tax codes have been applied to pension income. While HMRC insists the deductions are legal and necessary, pensioners and advocacy groups argue that the process lacks transparency and risks pushing vulnerable people into financial distress. For pensioners already struggling to make ends meet in the wake of a lingering cost of living crisis, the sudden loss of £300 in a single month can feel devastating. To understand why this is happening, it is important to look at how pension income is taxed. The state pension, which for most people is paid every 4 weeks, does not have tax deducted at source. Instead, HMRC adjusts the tax code applied to other forms of income, such as occupational or private pensions, so that the correct amount of tax is collected overall. However, when tax codes are applied incorrectly, when changes in pension income are not updated quickly, or when communication between HMRC and pension providers breaks down, underpayments accumulate. In some cases, this can go unnoticed for months or even years. By the time HMRC identifies the mistake, the shortfall can total several £100s, and in 2025, the government has chosen to recover those debts more aggressively, often through automatic deductions directly from pensioners' accounts. The size of the deductions has become a particular point of alarm. The figure of £300 is frequently mentioned, though the actual amount can vary depending on the scale of the debt. For a pensioner living on £12,000 a year, £300 is the equivalent of losing nearly a quarter of a monthly income. This could mean the difference between paying the council tax, covering a gas bill, or having to cut back on groceries. Consider the example of a retired factory worker in Sheffield who receives a modest state pension and an additional pension from his former employer. After discovering an error in his tax code, he was told that he owed £600 in underpaid tax. Rather than being offered a gradual repayment plan, he found 2 consecutive deductions of £300 each taken from his bank account in June and July. He described feeling robbed without warning, even though HMRC eventually explained the reason behind the deduction. His story reflects the sense of confusion and frustration felt by many. HMRC points out that these powers are not new. Since 2015, the department has had the legal authority to recover debts directly from bank accounts, a process known as direct recovery of debts. At the time, ministers promised it would only be used as a last resort and with safeguards in place to protect those in hardship. But in practice, pensioners are finding that these deductions are being used more frequently in 2025, particularly when it comes to tax code errors related to pensions. Critics argue that this shift undermines the original assurances, with the burden falling disproportionately on older people who may have limited ability to challenge the deductions or negotiate repayment terms. Charities such as Age, UK and Citizens Advice have raised the alarm, warning that the system is far too complex for many pensioners to navigate. Tax codes themselves are notoriously confusing, and unless pensioners regularly review their paperwork, errors can go unnoticed until HMRC steps in. Pensioners in their 70s or 80s, many of whom are not comfortable with online systems, face an uphill struggle to even identify the problem, let alone resolve it. Age UK has stressed that while HMRC insists letters are sent in advance, in practice many pensioners receive the notification only after the deduction has already taken place, or they fail to fully understand what the letter means. the human impact of these deductions cannot be ignored. For pensioners living alone, often widowed, and without family nearby, the sudden disappearance of £300 can trigger anxiety, fear, and in some cases even depression. The idea of being punished financially, despite believing they had followed the rules, feels like a betrayal after decades of paying into the system. A retired teacher in Birmingham described bursting into tears after seeing her bank balance reduced unexpectedly, saying she had never owed money to anyone and could not understand how such a mistake had happened. Stories like these highlight that this is not simply about numbers on a page, but about dignity, security, and the peace of mind that older people should enjoy in retirement. There are, however, steps pensioners can take to reduce the risk of being caught out. Experts recommend checking tax codes regularly, particularly if you have more than one source of pension income. For example, if your state pension is paid at a rate of £230 a week, that income must be accounted for in the tax code applied to your occupational pension. If it is not, then too little tax will be collected and an underpayment will build up. Even something as small as a digit out of place in the code can create errors worth hundreds of pounds over a year. Pensioners are also urged not to ignore letters from HMRC. While the language may be complicated, seeking help from a family member, financial advisor, or charity can make a crucial difference. If deductions are already being made and the sum is unaffordable, pensioners have the right to request a repayment plan spread over time, but HMRC will only consider hardship if the pensioner actively contacts them. Fraud is another growing concern. Scammers are quick to exploit fear and confusion around tax and pension deductions. Fraudulent emails, phone calls, and text messages pretending to be from HMRC are already circulating, asking pensioners to provide personal details or pay money directly to supposed HMRC accounts. The golden rule is simple: HMRC will never ask for your bank details over email, text, or phone call. Genuine deductions will appear clearly as HMRC on your bank statement, and official correspondence will always include your unique taxpayer reference. If you are unsure, call the official HMRC helpline using the number listed on the government website, not one given to you in an email or text. Protecting yourself from scams is just as important as resolving genuine deductions. The wider question many are now asking is whether the system is fair. Pensioners worked for 40 or 50 years, paying national insurance and taxes faithfully, only to find themselves penalized by bureaucratic errors. While the government maintains it is simply ensuring everyone pays what they owe, critics argue that older citizens should not be forced to shoulder the consequences of a complex, error-prone tax system. Calls are growing for HMRC to improve communication, simplify tax codes, and offer more compassionate repayment arrangements. Some MPs have even suggested a review into how pension taxation is handled, particularly given the aging population and the reliance of millions on both state and private pensions. As the summer of 2025 continues, pensioners are being strongly advised to remain vigilant. Even those who have not yet experienced deductions could still be affected in the months ahead. The £300 figure making headlines may not apply to everyone. Some deductions could be smaller, but others may be significantly larger, depending on the size of the underpayment. Awareness is key. Checking pension statements, keeping records of all correspondence, and seeking advice early can prevent nasty surprises. Ultimately, the message is one of caution and preparation. Pensioners are urged to take control by asking questions, confirming their tax situation, and not assuming the system is automatically correct. By being proactive, you can protect yourself from unexpected deductions and ensure that your hard-earned retirement income remains secure. If you value clear updates on issues like this, take a moment to like this video and subscribe to the channel. Staying informed about HMRC the Department for Work and Pensions, and the wider changes affecting pensions and retirement is not just useful, it is essential. Your pension is the result of decades of contribution and sacrifice, and you deserve to know exactly how it is being managed. The news that £300 will be deducted from some pensioners' accounts is a sharp reminder that vigilance matters, but by staying informed and engaged, you can protect your financial well-being and preserve the independence you worked so hard to earn.